Let me throw up this chart as to where we're at when it comes to that dollar-yen trading pair. And we are, seeing a little bit of a settling down, I suppose, when it comes to the market reaction, but still breaking below that 200-day moving average and consolidating at around 132. So we're watching for about that 130, which it didn't manage to breach. What needs to be the next driver when it comes to that upside pressure?
Look, I think we have the inflation data ahead of us, and that is something we're watching very closely. Inflation in Japan has been rising. We're all focusing on the wages and services side of things. As with all other global economies, there is a risk to an upside here, and that's probably going to set the path for the yen and possibly the BOJ into next year.
So when it comes to the path of dollar dominance as we get into 2023, the general consensus is, with these recessionary fears that we'll see more weakness. But at the same time, on so many occasions this year, we've seen at a time of volatility, investors are still flocking to King Dollar.
I think that's going to remain, especially in the first half of the year. The fact of the matter is, recession risks are not fully priced in. Further to that, where else are you going to be able to get 5% in a safe haven currency when you compare that to Swiss and the yen? They still have some room to grow there. And of course, I think from a fundamental perspective, in terms of rate cuts, we're probably looking at that coming in the U.S. in 2024. So this overvalued dollar will potentially remain, at least for the first half of the year, as economic conditions globally continue to slow down.
Not to mention, of course, the Fed tightening continues, and of course, there'll be more hawkish than markets had expected. Same for the ECB, right? Where does that leave the euro?
Look, I think the euro, that was a big surprise. We think that the European zone has a lot of challenges at this stage. Look, Lagarde and team, they could raise rates, interest rates to 3.5 or even higher to fight inflation. But all of that is also going to have a stronger impact on the weaker areas in Europe. So it's hard to see, how much of impact, aggressive rate hikes in Europe would eventually have on the euro, just because, you've got issues around Italy and the rest. And this time there's going to be no rescue package because the focus is purely on inflation.
Inflation, the energy crisis also continuing in Europe. Where does that leave commodities currencies as well?
Look, I think with commodity currencies going forward into next year, there's a scope for differentiation. When we look at Aussie, Kiwi, and Canadian dollar, we definitely think that Australian dollar, from an economic fundamental perspective, is in a stronger place into next year. We know that the New Zealand dollar and the Canadian dollar, in terms of structural deficits, are pretty wide. They also have a high debt to GDP as opposed to Australia. So going forward, there will be a differentiation into probably the second half of the year as these three currencies move and trade more towards the fundamentals, in which Australia will be supported.